Welcome back to Morning Trade Live. It's time to go inside out on Target. It was one of America's favorite stocks. Now less so, because this thing has gone from $183 down to $87 over the last few years. So Burt Flickinger, Managing Director, Strategic Resource Group, is with me. You watch everything. You do the channel checks. Of course, you're keeping an eye on the stock. But what did Target miss? And the foreseeable future, is it any better?
No, Nicole, it's got 7 things going against it and 5 things going forward. The result of that is Target has the lowest PE valuation, and it's still overpriced. Goldman Sachs expects the stock to decline another 11%. Here's what's wrong, Nicole. Bad board. It's been a bad board for 25 years. Too much insider Minnesota, too many board members and managers with quote unquote bubbles on the brain. They came from Coca-Cola, Pepsi-Cola, no relevant retail experience, poor distribution system. Blame that on prior board chairs and lead independent directors, John Stump, Rob Ulrich, Greg Steinhoffel, reflectively focus on urban areas, high operating costs, high crime, weak fresh food strategy, declining sales, as you referenced, Nicole, for 3 years straight, struggling for out of stocks, courtesy of McKinsey. In my professional view, what are the positives, Nicole? Why is that important? Very competitive pricing. Strategic Resource Group just completed a national pricing study on Target. They're within half a penny, Nicole, of Walmart, Demoulas Market Basket, Winco, Costco. Very competitive on pricing. Best in philanthropy. Communities love them. Best in security, Nicole, for shoppers, workers, vendors, where Walmart's the worst. Walmart, in my professional opinion, is unsafe to shop. Target with Rondell advertising is a big plus. So where does that lead us, Nicole? The summary is Target, because it's so undervalued, to your present point, Nicole, is a prime takeover candidate, either by Metro, which bought out our family's company, SM Flickinger Worldwide, wants to get back in the United States. Number 4 retailer worldwide, perfect fit for Target, or potentially private equity. Full disclosure, we worked for 14 months worldwide on the due diligence of Whole Foods to buy, which was ultimately bought by Amazon. Target's the perfect takeover candidate because they're rudderless retailer, Nicole, unless somebody takes them over, is epitomized by their abject failure in Canada. They're failing in the U.S., and the XRT, the S&P 500 retail index, is trading 30% higher than Target. Walmart, obviously, almost 70% higher than Target, and Amazon more than triple Target. So Amazon needs a better board, better management, retailers, practitioners, and not politicians who come from CPG vendors who have nothing to offer to Target for retail when they're in the Target's in the fight of its life for viability and relevancy in retail.
So I love that you say this is possibly a takeover target, but the question is, what would it be purchased for? It's at $102, and often we see the company that would be acquired surge because, would it be a take under or a takeover? Because you're saying that the PE value is even, you know what I mean, right? Is that a good question? Because you said Goldman Sachs thinks it has another 10% to the downside. So maybe it wouldn't be a takeover, maybe it would be a take under. Because when I hear takeover right away, I'm sure people who know Wall Street say, oh, I'm going to buy it. Is it a takeover target? I'm going to buy it. Not if it's going to be a take under, then you don't want it. What do you think?
Nicole, you're so completely correct. It's a take under, which would probably get a premium valuation of 112 to 115. But there's a cleanup at Target in aisles number 1 through 30 and checkout registers 1 through 26. It's like the 12 labors of Hercules. This is something that cannot be done in a week. It's going to take years. And whether it's Eric Rieger and his team at Metro, whether it's Kroger and their team, I don't think it's going to be Jeff Bezos. From our due diligence on Whole Foods, Jeff Bezos and Amazon comped negative for 5 years in a row, so they don't have the chops for turnaround retail. So it's got to be Metro, potentially Kroger is a dark horse. But the company by itself especially with a poor executive search firm work in selecting board members and executives and bringing in McKinsey expats and blowing out the best and the brightest women from the local Minnesota and Midwest colleges and universities who built Target into a powerhouse. Unless you get rid of McKinsey, get rid of the board, get rid of management, and start all over again and do a fresh restart with the best and brightest women and people of color, Target will have a tremendous turnaround and can get the stock back up to 140, 150. Without that, you need Eric Rieger and Metro or someone like that, potentially Kroger, to merge with Target, because Target by itself right now is unsustainable. And to your point, it's taking under, and it's going to drop 11%. I think Goldman Sachs minus 11 is conservative. It could drop minus 12 to minus 20% once we get through a bad back to school and bad holiday season at Target.
Wow. So you would think even further, so you wouldn't touch this stock today.
I own it, Nicole. I'm not happy about it. I've owned it for 35 years. Our family started in business with the Dayton family in 1902 and lifelong loyal to the Dayton family and Target, but wouldn't buy any more, that's for sure.
So at this point now, we have the must-have back-to-school items. Then it's the holidays, but there's still summer items that are always in the aisles that people pick up. You do have the battle right now with Amazon's Prime Day days ×4 going on right now. Walmart and Target Circle. So it's like Walmart deals, Target Circle Week, and of course Amazon Prime Day ×4. A quick thought there. Are people spending? Are we going to see some records?
Not spending, Nicole, and as you and your superb Schwab team presented pre-market, Walmart's down to open the market, Target's down, Amazon's down. Why is that? Amazon, as of last night, was down minus 14% versus prior year on day one. Why is that important? Because Alibaba on Singles Day in Canada, in China, produced $100 billion in sales in one day, Nicole, and Amazon's struggling to produce $10 billion, hopefully $15 billion over the course of Prime Day. Walmart's struggling, Amazon's struggling. 70% of the consumers are cash and credit constrained, can't pay their bills, and Target's not saving enough money, nor is Walmart, nor is anyone else. The only one that's saving consumers money is Kroger, Costco, and Winco at the grocery store, because that's the only place people can save meaningful money to pay their bills and keep their houses, keep their cars, and keep their kids in school.
Well, it looks like they have some things going for Target, and that is the premier pricing. You said they're within half a penny in the price game, so the competitive pricing sounds wonderful. And the safety check, as you noted, really good versus the likes of Walmart. You said unsafe. And last but not least, a lot of young folks want to go or work at companies that are reputable in the world of philanthropy, or have checked the boxes in the good stuff, you know, in the good, nice column. So the philanthropy helps them, and so communities like them. Those were some good points, Burt. It's wonderful to see you. Burt Flickinger.
Yeah, one fast footnote, Nicole, it's important. Target's fantastic on exclusives with Taylor Swift. One more exclusive with Taylor Swift and one more Taylor Swift concert tour can solve a lot of the issues at Target for a long time. So we're hoping Taylor goes back on tour before or after marrying Jason Kelce.
Yeah. Wait, isn't it Travis?
Travis, thank you.
Yeah, and I don't even know that they're engaged. But
Jason's the brother, they're not, but Taylor Swift tour would be the strategic solution to save a lot of problems at Target.
All right. Obviously, you and I are really Swifties. Maybe not. Burt Flickinger, Managing Director of Strategic Resource Group. Thank you.
Thank you. Always
Tom White, host of Fast Market. I'm going to go ahead and say he's probably not a Swiftie either. Let's take a look at Target here. He noted that while, you know, the PE value here, we look at that, right, those PE ratios, less than some of the others, but really still has room to the downside. It's overvalued even here. Tell us about an example trade. Good morning to you, Tom White.
Yeah, good morning, Nicole. Maybe I'm not as sour, and my example trade's going to kind of reflect that. But even if the stock kind of just consolidates, you can still profit from this type of strategy that I brought to you today. So I looked at something neutral to slightly bullish, taking advantage of yield on this strategy because Target still pays a 4.45% dividend yield. So that's pretty positive from that side. The stock's down in bear market territory, still over 20% below those recent highs. It's pulled back pretty significantly. So I looked at a covered call strategy where, maybe somebody wants to own the shares, collect that dividend, but then create some yield on those long shares also. So for every 100 shares of stock you buy, I looked at selling July 18th monthly options that expires in 9 days, the 105 strike calls. So there's your covered call strategy. You're paying roughly about $101.30. It's probably a little bit higher. The stock has moved higher. But the debit you pay is going to be your break even. So you're buying the shares at a discount because you're selling that upside 105 call against it. That allows you to collect that dividend because you own the shares and create yield on the short call above it. Now, as you get closer to expiration over the next week and a half, the idea is, hey, I'm still long the shares. I'm going to buy that short call back that time decay or theta is taking advantage of, and it's contracted the price of it. I'm going to buy that back and roll to another weekly or monthly cycle. That allows me to collect credits, right? And that allows me to get my break even lower every time I roll or adjust that short call over the duration of the trade. And as I mentioned, you're collecting that 4.45% dividend yield, and you're also collecting yield on that upside call. So this might be the way to look at it because I think there's a lot of people out there that want to buy the shares, but this actually gives you a little bit paid to wait type of strategy.
All right, look, he said, there were some things he had in the positive column. So, we'll see. And thank you for that example trade. How about for Walmart? This was a name that many guests came on and picked. They got tired of picking Target, so they started picking Walmart. Your thoughts here on an example trade?
Yeah, the stock's still off about 7-8% from those all-time highs above $105 a share. It has pulled back, but it's really started to consolidate. So I'm going to look at a different strategy than the covered call I did in Target, but it's going to have the same risk profile. It's not a covered call. It's a cash secured put that's neutral to bullish in stance also. So you're going to recognize the maybe the risk profile from this one. It mimics the Target one, but you don't own the shares. So I went out to the August 1st weekly options, about 3.5 weeks till expiration. I'm just going to sell an out-of-the-money put, sell the 95 strike put. You're going to collect a credit of roughly about $1.30 on that. It's probably a little bit lower. You might want to adjust your strike because the stock has consolidated just below 97. But if you sell that put, you collect a credit on it, right? $1.30 credit. So that's what you can profit on this trade, $130, right? But it takes your break even down to 93.70 over the next 23 days. So you're buying, you're basically getting the shares or collecting and have that cushion to the downside before you start getting hurt of just over 1%, about 1.5%. So it's the same risk profile as a covered call, but you're giving yourself a little cushion. Now, if the stock does fall below 95 into expiration in 23 days, well, then you're going to have to purchase the stock, right? If you stay short that put and it's below. But you're purchasing the shares at 93.70 to the downside. So you're buying the shares at a discount if it does fall below 95. If it doesn't fall below 95, you just get to keep the credit that you collect. But it's the same type of a view on the risk profile that a covered call is. This is just a cash secured put.
Okay, Tom White, great to see you.
Thanks.
Thank you so much. A good look there at Target and Walmart today.